Hello, everyone. Matt Somberg, partner and co-founder, Gottfried and Somberg Wealth Management. Happy fall. Hope you're well. Brief video today to cover a couple of topics. We just had a Fed interest rate cut. We have an election coming up, and we have a stock market that will be positive for its 8th month out of 9. So a lot to discuss. Start first with the major markets. So it's been a great year so far. S&P up 21, NASDAQ up 21. International non-US stocks up 14, and the bond market received a boost last week with the Fed's interest rate cut up between 4 and 5%. In terms of the calendar year, we're finishing up September as I record this, so that's 9 months under our belt, and stocks will be positive 8 out of 9, which is very unusual. A couple of small dips along the way. April was the one down month. Then late July, early August, we had a bit of a sell-off because of some transactions tied to the value of the currency in Japan. And the first couple of weeks of September were not good, but the month has rebounded nicely. So again, as we conclude September, market positive 8 out of 9 months. We certainly would have signed up for that at the start of the year. Historically, September and October are the more volatile months. But again, September has been positive. We'll see what happens in October. The fall does tend to be the most volatile quarter of the year. So the big news really was the much awaited and anticipated end of interest rates going up and the beginning or the potential beginning of interest rates going down. As we've mentioned in our videos, really over the last several years, the Fed raised interest rates to try to tame inflation and slow our economy down. The economic data that has come in for much of this year has shown that inflation, year-over-year inflation is slowing or has slowed. The unemployment rate is actually tipping up. More people are looking for work. So those are both signs that the economy is softening. And so there was some debate if the Fed was going to cut by 1/4 of a point or 1/2 of a point in their September meeting, but they did cut by 1/2. And investors, if we had to predict how the rest of the year looks, do expect or anticipate 2 more rate cuts before the end of the year. So where will you see this impact? So when the Fed cuts interest rates, oftentimes investments like US Treasuries or money market funds or CDs, things that are very tied to short-term rates, will come down. So if you're invested in a money market fund, within a month or two, you may see a decline. If you walk into your local bank, you may see that CDs that are being offered a couple of months from now will potentially be offered at lower rates than what you're currently seeing. If you have variable debt, like a line of credit against your house, you may see that rate start to come down a bit, which is good for borrowers. And for those of you that are refinancing a mortgage or looking to buy real estate, you'll likely see some mortgage rates start to dip in the next couple of months as well. So it's definitely month to month in terms of how the Fed is behaving. They're receiving data each month. They're seeing if the economy is softening. And if they do believe the economy continues to soften, we should expect some ongoing interest rate cuts between now and the end of the year. These interest rate reductions are happening not just here in the United States, but around the world. Around the world, inflation is softening. Around the world, central banks are reducing interest rates. So what do interest rates cuts means? We know what it means for short-term borrowing and for short-term fixed income investments, but what does it typically mean for the stock market? Historically, how have markets performed when the Fed has cut interest rates? So what the Fed is doing right now is what's called what we would call an insurance cut. The Fed is reducing interest rates to try to provide some insurance for the overall economy. The economy is doing well, but it needs a little bit of help. That's different than when the Fed cuts interest rates when we're in the middle of a recession and the Fed is trying to really pull the economy back out of a deep recession. That's not what's happening right now. So if we take a look at the green line, which is the top line, this looks out 18 months and says, what have markets done 18 months after the Fed began doing insurance cuts? And this looks at 4 previous examples when the Fed did this, 1984, 89, 95, and 98. The average return of the S&P 500, 18 months out after the Fed began doing insurance cuts, is over 30%. So that's pretty significant. The opposite of that is when we're deep in a recession and the Fed begins to cut interest rates to try to pull us out of a recession. You might say that's an example of doing too little, too late. But in those examples, 80, 81, 2001, and 2007, 18 months out, the market was actually down 14% from where it was when the Fed started cutting interest rates. So it's just history and past economic data. It does not mean, of course, that that's exactly what's going to happen going forward. But we do have 4 previous examples of similar situations where the Fed was cutting interest rates at a time when the economy was actually doing pretty well. And the market 18 months later was a fair amount higher than it is at the current moment. So that would be bullish and optimistic. And I think we would all welcome that if it in fact did take place. Digging just a little bit deeper into the market, our economy is comprised of about 11 sectors, and this shows you the year-to-date returns for all sectors. 11 out of 11 are positive. There's not a negative sector year-to-date. The 2 top performing categories are technology. Technology is where you would find the semiconductor chip makers, names like NVIDIA, for example, which have done terrific this year with the push for artificial intelligence to be incorporated into more businesses. And then maybe a little bit surprising, utilities have been the second best performing category. Some of that is driven by the fact that the energy that is needed to produce artificial intelligence is quite high. And so there's significant demand on utility companies to be able to provide that. So there's definitely an element of that. The 2 worst performing categories, if we want to say they're the worst, which is real estate, which is up over 10%, tremendous demand for home builders, for example, and energy, which is up only 5. We've actually seen energy prices come down a bit most recently. So energy year to date is actually the worst performing categories, but positive across the board from a sector by sector standpoint. Final quick topic. There's an election a few weeks away, and we've had some slides in the past that sort of show how markets perform just in an election year in general, whether you have a winner that's a Democrat or a winner that's a Republican. This slide's a little different, takes it a step further. It's maybe some new data or a new slide for you. So what this does is this shows you when you have a Democrat president or a Republican president that wins, not only how do markets perform, but how do markets perform based upon the composition of the Congress that they have to deal with. Okay, so for example, on the Democrat side, when a Democrat has won the presidency going back to 1950, if both houses of Congress were controlled by Democrats, so you have the same party in control of everything on the Democrat side, the market returned 8.7. If you had a Democrat president with a Republican-controlled Congress, 14.5. But when you've had a divided Congress, meaning absolutely nothing is likely to get done, the market has actually returned closer to 16%. That's on the Democrat side. On the Republican side, the numbers are different, but it's the same story. When you'd have had a Republican president with a Democrat Congress, during those years, the S&P returned +1. Republican president with Republican-controlled Congress, S&P returns 11.7. But when you've had a divided Congress, the returns have been the best, over 12%. So again, this is historical data. It doesn't mean that if this were to play itself out in this election cycle, you would see the same returns. But maybe for those of us skeptical of what happens in Washington, a divided Congress usually suggests that not a lot gets done. And at least from a historical standpoint, that seems to be when the markets have done their best. So take that for whatever it's worth. So appreciate your time today. Appreciate, obviously, the ongoing trust and confidence that you place in our firm and all of our advisors here. It's been a great year so far. It'll certainly be an exciting next few months between now and the end of the year. Be back in a month or so with another video update. And of course, if you need anything from us at any time, don't hesitate to reach out. Thanks very much.